Anil Sarin is joining us from Centrum. Good afternoon, Anil. Market has the habit of looking for some new worry every now and then to latch on to and negotiate. So, what new worry do you think lies at the horizon?
No, I can't think of a new worry. The old worries are plentiful enough. So till the first rate hike happens, people are going to keep on speculating. Is it going to be 25? Is it going to be 50? And then the whole liquidity. So I think that is the elephant in the room. Ukraine was troublesome, and for the moment it appears to have receded into the background. But honestly, to answer your question, I can't think of a new worry. The old worries should resurface. A sideshow, of course, is the price of oil, which is continuing to cause problems. So I don't think that there's a new worry I can think of.
So, we were talking to Mr. Fradun Fisharaki also this earlier in the morning on our channel, and it appears that large parts of the oil producing community are thinking to ramp up their production. And as they say that the remedy to high commodity prices is actually high commodity prices. Right. So, if that actually balance lies ahead, right, few months ahead, and of course, Crimea also. What about rate hike? Do you think that market will start moving out? At least that worry will be out of the window the moment first 50 basis point rate hike comes in the US?
I would be in that camp, yes. The fear of the pain is more real than the actual pain itself. So as they say, I mean, buy on rumor, sell on news. So here it seems to be sell on rumor. It might just happen that people might want to buy on the news.
Now these 2 points have been established, Anil. Next 3-year window, people who are positioning and buying the dips for next 24 to 36 months, how does the picture look? Because, last year and year before last, there was a lot of lumpy gain clubbed into a year. Yeah. I don't know how many would have participated because the fear was also very ample. But now things, the visibility of earnings growth, capex cycle, it's quite nice. Do you think it makes, very big sense to position yourself with a 3-year window? How would your portfolio composition look like?
Absolutely. We have not felt more confident about the Indian economy any time in the last 8-9 years as we feel now. The corporate balance sheets are the lightest they have ever been since the year 2005. And there is this globally coordinated kind of a capex boom, India included. So the setting is very good. And there are multiple industries which were not doing well earlier, namely, let us say, real estate, textiles, telecom, cap goods. So many industries are now participating. So what we have seen is that markets don't go down in the environment of rising earnings. And we are in the environment of rising earnings. So a lot of people have sat, as you mentioned, on the sidelines. They should now, see, there is this lot of these smart traders who have made a lot of money and they are booking profits now. But that I don't think should be taken as the last word. This is a year you should be, very carefully picking up your stocks. And from a 3-year perspective, there's a very, very high likelihood of you making great returns.
So, Anil, what is your model portfolio looking like? If you could share some big, if not stocks, at least the themes and the way you're capturing it. And also, I want to understand what kind of earnings growth your model portfolio is throwing up. Are earnings doubling in the next 3 years?
So we are constructive, obviously, on private sector bank. Basically, lenders of any shape or color. We love them. We like real estate quite a lot. We love hospitals, and we like logistics. So I would say a large part of our model portfolio is stacked with these 3 or 4 themes. Speaking about earnings growth, I think within this year, fiscal 22, our model portfolio should be growing between 36 to 38% at the EBITDA level. And there is not much of interest, there's not much of depreciation. So a lot of it can be taken to be at the bottom line level as well. And the following year, we expect similar or slightly reduced, earnings growth. So let's call it 36. So this is a very good setting. On a PEG ratio basis, our portfolio is less than one time. So strong earnings growth coupled with valuation, which is not, it is on a headline basis pretty high, but adjusted for the earnings growth, not too demanding. So I think it's a good setup for a 3-year kind of investor.
Wow. So, if I even conservatively talk about the earnings will be doubling in 2.5 years for your model portfolio. What is the largest composition of big earnings contributor there in all these four?
So we tend to be bottom up, but I think as a block, I think lenders are going to be doing quite well. So far, I mean, in the last 2 quarters, we have seen that the loan growth has picked up, and that's very obvious. But the bulk of the money is being made in not providing any more because of excess provisions already sitting. So you're finding that the top line is moving at a certain rate, the bottom line is moving at a much, much faster rate. Going forward, we are going to see that the loan growth itself is going to return to trend of whatever 14-15% or so. And the bottom line will not like go up very, very smartly because you would have already, the base would have gone up. So you can say roughly 20% odd is sort of baked into the lenders. Real estate will do much better because many of them have completed apartments, completed buildings where, they have not booked sales yet. And the costs are of older nature and the revenue is now getting booked. So you will see, so real estate again is going to give you a very, very strong kind of a comeback. And the remaining bulk of our portfolio is bottom up and they are very, very well positioned. We've got technology names, we've got digital oriented company names who have a very strong earnings profile. So yeah, I mean, it is a stock pickers market, but if you want to look at it thematically, real estate and lenders are going to grow. And if you compound at 26%, anyway, you double your money in 3 years.
Very nice, sir. Anil, also want to understand how real, because you're a practitioner of money management, right? You look at academic angles as well as practicing angles. Last 2-3 years, there was no earnings, but still stocks went up. And now next 3 years, only earnings backed stories will reward. So what about the fear of inflation remaining sticky, elevated here in India and abroad? How true is that fear? How much of that is baked in?
So we've gone back in time and we have seen what is the impact of various factors, interest rate, monsoon, inflation for sure, which is it's a proxy for interest rates anyway. But we have found that the factor that most closely correlates with market performance is earnings growth. So we all know that last 3-4 years, I mean, leave aside 21, till fiscal 20, India's corporate sector as a whole was not growing very well. So we know that it fell to below 2% of GDP corporate profits. And we can go as high as 8% of GDP, under certain scenarios. We have done so in the past. So as this earning cycle picks up, you are going to be able to justify the kind of market levels. For sure, there has been a lot of revaluation which has happened, upgrades in the price earnings multiple. But what we are observing is that there is a handoff happening. I mean, till a few years ago, quality was doing very, very well. So as long as there was revenue assurance, corporate governance, and balance sheet strength, you were getting more and more valued for relatively similar kind of earnings growth. Now the baton is changing hands. You're finding valuations are not so cheap. Earnings growth is quite high. And the balance sheet, which used to be a little shaky a few years ago, is now in pristine shape. So I think a different set of stocks will outperform, and you need to be cognizant of that.
Right. Okay. Anil, one word on how's your clients, what kind of queries are your clients posing? Because after all, that is in a way a reflection of what kind of money is likely to come in. FIs clearly have been sellers, but
yes.
What about your client set? What kind of issues are they discussing with you?
So I honestly, I think client behavior cannot be 100% dependent upon. Sometimes the best time is when the clients are really, really worried. At this point in time, to be absolutely honest, people have given us very little money out of the total which they owned. So as it is, they were exposing in a very limited fashion themselves to the equity class, to the asset class called equity. So as we speak now, clients are actually giving us more money. But there may come a time, I mean, there are n number of risk factors which we have already discussed and more will emerge. They may become very, very scared. But at this point in time, to answer your question, they are actually topping up, giving us more money.
Great. Let's talk about the most underperforming area of the market, private sector, retail oriented banks. What is taking, what's the drag about?
I think it is ownership. If foreigners who are the biggest drivers of, they were the biggest owners of private sector banks. I mean, it's a well-known fact that FIIs, if they want to play in a certain country, the easiest way to go do it is through the banks of that country, which is what they have done for India also. Now, if they are in retreat for whatever reason, they are going to sell what they have. So the biggest chunk of stock that they own was these private sector banks, and that they are feeling the brunt. But I think a changing of hands is happening. What we have seen is the impact of FII selling from, there was a time when their selling used to have a lot of sting, a lot of power. But last 4 or 5 years, we have seen that their selling is not as impactful. So as more and more Indians start participating, and we are seeing very, very clear evidence of more Indians participating, their ability to keep private sector valuations down will gradually go away. More and more people, I mean, today it is consensus. You ask any fund manager, he will say, I want to buy ICICI, I want to buy Axis. So sooner or later, the preponderance, the continuous buying by the domestics is going to overcome the continuous selling by the foreigners. And I think the stock performance will revert to being what it should be, which is strong upward momentum in some of these private sector names.
Right, lovely. All right, Anil. Okay, one more question before I let you go. Which is the most overvalued area of the market where there is froth, and what are the let me come here. A lot of consumer tech companies which recently got listed and are down 50-70%. Have you started taking a look over there? Is value emerging there?
Early days, I think the valuation was so bad, so egregious, that while we are taking a look at it, but we have to really stretch our imagination to justify. I think there is a little bit more to go. That is one aspect. Second is that when the shareholding changes, the management behavior also needs to change. Till some time ago, pre-IPO, the share owners were private equity broadly, and who had a land grab, who had a kind of a market expansion kind of an outlook. Now the shareholders are public shareholders who have a near-term kind of an outlook. They have a cash flow, show me the money kind of an attitude. So you will find the behavior of these recently listed consumer tech companies also changing, whereby they will start giving higher emphasis to, advancing the date of profitability, making it nearer than just going and expanding the market and doing a so-called land grab. So two things are going to happen. There is some more price erosion in store, at least that's what I believe. And second, these projections of, we will become profitable in 2027, 2030, etc. Some of those statements gradually will start changing, and those dates will start coming closer and closer, maybe something like 2025 or so, at which point, I mean, these are outstanding franchises. These are great companies. It is just that the interest of minority shareholders have to be aligned with those of the managers, and it is happening. And the valuation has to become. So I believe one should be ready. Sometime in the next 6 months, you will get your opportunities to own these great companies.
Right. Of course, price is the bridge, as they say, between great companies and great investments. All right, Anil, thank you very much for your time
Thank
today.
you.
That was
Thank you,
Anil
Prasad.
Sarin of Centrum.